Most people who run the wheel strategy have no idea what they're doing in terms of picking the correct strike price. I'm going to show you how I approach it. So first things first, I'm going to assume you have some sort of stock in mind already. For this example, we're just going to go with Procter & Gamble, and I'm just here on Yahoo Finance, and I'm going to add a couple indicators on here, right? So I'm going to click indicators, right? And I'm going to add two moving averages. I'm going to add the 200-day moving average and the 300. So click that moving average, and I'm just going to click 200 and 300 here. Now, once that's done, you could see that I have added 2 and 300-day moving average, my 300 being 164, my 200 being 161, current price of Procter & Gamble 150, so trading well below those moving averages. The next indicator we want to add is the RSI. Click it and just leave everything as default. Click done. This is going to add a little overlay here at the bottom of your chart. You can see right now the RSI is at a 36. So what does this mean? Well, this means that we're in oversold territory. This means that people are selling this off on the stock, right? So when people are selling a stock, right, it drives the price down. So anything below 50, 40, 30, you're going into oversold territories. Anything above 50, you're going into overbought territories. Now, one more indicator we want to add is those Bollinger Bands. Click it, and then right here, instead of 20, we want to put 30. And apologies for this crazy reflection. I just realized this is probably not really that good. But with that said, you can see the Bollinger Bands get added on here. Now, the Bollinger Bands, I like to use to kind of, I hate saying time the market, but it gives us the best opportunities for strike price selection as well as premium. So right here, you could see that PG is trading towards the bottom Bollinger Band. When it's trading towards the bottom Bollinger Band, again, usually it's oversold, which we can confirm, and we can usually get a better strike price because historically, now nobody knows what the market's going to do, indicators are fugazi, we don't stay at this bottom Bollinger Band area for too long, and usually we bounce off it. But again, we don't know if that will actually happen. But with that said, we can usually look at like a 145 put at this point, right? Where just like a couple weeks ago, if we did it when PG was trading at 160, we wouldn't even have any, there would be nothing there for us at 145, right? So that's why I like to have a larger watch list, like of a couple hundred stocks, because, you know, that way I can scan for these kind of setups every day. So I'm just here on Robinhood. I'm going to click sell a put and I'm going to go 30 days, whatever. We'll just do the 7th, right? And you could see here, right? I got my 150s that are paying $385 of premium. Obviously results vary. These are just the premiums I've seen at time of recording. And take a look at this, the 145s. About a 30% delta, 30% chance of assignment, 70% chance of expiring worthless for the most part, and collecting just about $200 of premium, or 196, which is pretty good. Now, again, this, you know, if PG was trading at like 160 right now, we would never be getting anything for this. You could probably see even here, like if we scroll down